This video will help you understand if you can make a traditional IRA or a Roth IRA contribution. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. So in the normal course of doing financial planning for the past decade, one of the most common questions and strategies we try to help clients implement are funding IRAs. So today, I thought it'd be helpful to break down the rules regarding when you can or can't fund an IRA, as well as how much you're allowed to put in. And while it might seem pedantic, I am going to clearly delineate between traditional IRAs and Roth IRAs because there is a difference for the purposes of when you can and can't fund them. Obviously, there's inherent tax differences, right? Traditional IRAs typically allow you to take a deduction and then put money in. Roth IRAs, on the other hand, do not permit a tax deduction, but as the money grows and compounds, when you go to distribute those assets, ideally they'd come out all tax-free. There's of course nuance to all this where you might lose the pure tax-free withdrawal benefits in a Roth IRA if you withdraw it too early or you violate certain rules. Today's not the day where we're going to get into the specifics on that, but to keep it simple, generally Roth IRA distributions are tax-free, whereas pre-tax IRA distributions are all income taxable. Also in today's video, we will not be covering SEP IRAs or simple IRAs. Those are a bit more nuanced and beyond the scope of today's video. So let's jump in. First things first, who is eligible to fund an IRA? Well, as of 2020, there are no longer age maximums as to who can or can't fund either traditional or Roth IRAs. Back in the day, there was an age barrier where if you were over the age of 70 and a half, you were not allowed to take the deduction on funding a pre-tax IRA. But that's no longer the case thanks to the original Secure Act 1.0 that was put in force in 2019. Also, there is no age minimum. As long as you have enough earned income, or your spouse does, you are eligible to fund a traditional IRA or a Roth IRA. Now, there might be some barriers as to what would prevent you from doing that, but technically you're eligible. Whether or not that eligibility is seen through to fruition, that will be dictated based on what we'll cover in this video. And relative to the no minimum age thing, technically there is no age minimum, but your state will have mandates as to how early somebody can start earning an income and start earning a wage. And since you can only put money into an IRA if you have enough earned income to justify that contribution, then ipso facto, if you are below the minimum working age in your state, you're probably not going to have earned income, and therefore you would then be ineligible to fund an IRA. That's probably why you don't see a bunch of 5-year-olds funding Roth IRAs. For 2023, the maximum anyone is allowed to put inside of an IRA, whether they take the deduction or not in a traditional IRA or they fund a Roth IRA, is $6,500 if you're below the age of 50. If you're 50 or older, you're permitted a catch-up contribution of an additional $1,000, making your total contribution $7,500. In addition, as long as someone has enough earned income, they are permitted to always fund a traditional IRA. However, whether or not they can take that deduction on the money they put in, that would be dictated on some stuff we'll cover further on. So theoretically, even Elon Musk and Jeff Bezos can all fund traditional IRAs at that $6,500 mark, or $7,500 if they're over 50. But whether or not they can take the deduction, that'll be dictated based on some further nuance we'll cover in a second. And when I say you have to have enough earned income, that doesn't mean you make $1, therefore now you have enough earned income to fund an IRA. You have to at least make enough in earned income for the amount that you're planning to put into the IRAs. So for example, I would need to earn at least $6,500 if I want to put in $6,500 into my IRA. In addition, if me and my wife want to fund IRAs, but my wife takes care of the family, she doesn't earn a wage, I would need to earn at least $13,000 so that we can both fund $6,500 into our IRAs, respectively. The IRS doesn't really care who makes the money, just as long as the married filing jointly household makes enough to permit both people funding IRAs. Okay, so let's fast forward. Let's say you or your spouse have enough earned income to permit one or both of you to fund IRAs in some capacity, whether it's traditional or Roth. However, there are still going to be some barriers that might make you ineligible even if you made enough money. So colloquially, these barriers to entry are going to be called income limits. Technically, these are going to be based on your modified adjusted gross income numbers. Those might be too high to permit you to fund these various accounts. But again, to clarify, anybody can fund a traditional IRA as long as they have enough earned income. Just whether or not they can take the deduction, that's where this comes into play. We'll touch on later why you would or wouldn't want to take a deduction out of a traditional IRA. Most people do want to take the deduction, but there's some reasons why you might not want to take that deduction. Okay, so if it comes down to your modified adjusted gross income, whether or not you can fund these various accounts, the number one question I usually get is, how do you calculate modified adjusted gross income? Well, luckily the IRS makes it very simple. They have a calculator on the website you can work on. It's on a worksheet. I'll link below to the IRS website, and specifically you're looking at worksheet 2-1. To keep it simple, however, your modified adjusted gross income is your adjusted gross income plus a couple onesie-twosie items that get you to a modified adjusted gross income level. A lot of times your AGI and your MAGI are the same number, but they could be different, and so you're going to want to run through the calculator. So if you reach a certain level of modified adjusted gross income, which colloquially we'll just call income limits for the purpose of today's video, those income limits, if you reach them, will prevent you from fully funding an IRA. So first let's talk about Roth IRAs. For the tax year of 2023, if you're a single individual whose modified adjusted gross income exceeds $138,000, you will not be able to fully fund a Roth IRA. In addition, if you're married filing jointly, the modified adjusted gross income maximum for the family to be able to fully fund their Roth IRA contribution is $218,000. If your modified adjusted gross income reaches those aforementioned levels, you might not be able to fully fund a Roth IRA for this tax year. However, it doesn't mean you're ineligible to fund anything into your Roth IRA. You might be permitted to fund a Roth IRA, but at a reduced amount. And the dictation for that reduced amount is going to be based on your modified adjusted gross income falling in between what are called phase-out levels or phase-out ranges. This is essentially where your modified adjusted gross income falls in between a lower and an upper barrier, and we'll touch on that in a second. We'll also cover in another video how to actually calculate if your modified adjusted gross income levels fall in between these levels, how much of the total $6,500 of Roth IRA contributions for 2023 you'd be permitted to make. AKA, how much do you have to take away from that $6,500 maximum to calculate what you are permitted to put into a Roth IRA. So those phase-out ranges for a single individual are if your modified adjusted gross income is between $138,000 and $153,000. If you're married filing jointly, those phase-out ranges are $218,000 to $228,000. So again, if your modified adjusted gross income levels fall in between those ranges, you're permitted to fund a Roth IRA just at a reduced amount. And if your modified adjusted gross income levels exceed the upper bounds of those ranges, then you are not permitted to fund a Roth IRA at all. And all of these rules apply to spousal Roth IRAs as well. So now that we've talked about when you can or can't fund a Roth IRA, let's talk about when you can fund a pre-tax traditional IRA. And again, pre-tax is the caveat because anybody can technically fund a non-deductible traditional IRA if they have enough earned income, but the real value of funding a traditional IRA generally is around taking that tax deduction. Let's touch on who can and can't take a tax deduction on funding their traditional IRA. In some ways, it's easier to qualify to fund a pre-tax traditional IRA, but in other ways, it's far more complicated. All you need to do to qualify to fund a traditional IRA is make enough in earned income, aka above $6,500 for 2023, and don't have access to an employer plan through work. Now that's really the problem because most people I work with have some form of employer plan, 401k, 403b, 457b, etc. And if one of the spouses does have access to an employer-sponsored plan, the IRS calls them an active participant and it changes their rules for qualification. So to clarify, if you don't have access to a retirement plan through work and you make enough in earned income to justify funding an IRA, you are permitted to fully fund a pre-tax traditional IRA. I'm imagining the IRS just doesn't think you have access to any sort of retirement plan, so they're going to permit you to take a pre-tax deduction and fund an IRA at those maximum levels, no matter what your income is. However, if you are considered an active participant and you now have access to a retirement plan through work, then we enter into those phase-out limits once again. And those phase-out limits are going to be if you're single and you make between 73 grand and 83 grand, that will dictate how much of that pre-tax IRA contribution you're allowed to deduct. If you're married filing jointly and you make between $116,000 and $136,000 of modified adjusted gross income, that will dictate how much of that total $6,500 you're allowed to take a tax deduction on when funding your IRA. And a very weird one is married filing separately. Those phase-out ranges are $0 to $10,000. That's very weird, and I'm guessing the IRS just doesn't want you to file this way, which is why they're making it very confiscatory as to whether or not you can fund a pre-tax traditional IRA. And one more time, this ineligibility or these phase-out ranges simply dictate how much of your IRA contribution is tax deductible. You could theoretically fund your traditional IRA at a total $6,500 for the year, but how much you're allowed to tax deduct will be dictated based on these phase-out ranges. But what about the spouses? So we covered what the rules are if you are an active participant, but what if you're the non-working spouse and you're married to someone who's an active participant? The spouse who's the non-active participant will be allowed to fund a pre-tax IRA, and their phase-out ranges are the exact same for married filing jointly relative to Roth IRAs. And once again, that's $218,000 to $228,000. And while these numbers might seem entirely arbitrary, I'm guessing the real reason why the IRS sets those phase-out ranges for the spouse to fund a pre-tax IRA and the ability for married filing jointly folks to fund Roth IRAs, the reason I think those phase-out ranges are the same is because they don't want the non-working spouse to be disenfranchised from being able to save into a retirement plan, regardless of what the other spouse makes. So now let's fast forward and say your modified adjusted gross income levels exceed all these phase-out ranges and you're an active participant. Now what can you do? Well, as mentioned before, you can fund a traditional IRA and just not take a tax deduction. That's doable. And there's a couple reasons why you might want to do that. If you're not planning to touch this money until retirement, aka over 59 and a half, the tax deferral you'll receive within the traditional IRA is obviously more efficient from an investment standpoint than the taxable capital gains and income you'll pay on a non-retirement account's growth. So if we're just looking apples to apples and we're saving for retirement, by definition, a tax-deferred account will accumulate faster than a taxable account. Now, there are some drawbacks to funding a traditional IRA and not taking a tax deduction. Most notably, of course, is you don't get to take the tax deduction on today's taxes. And when you go to pull the money out in retirement, the growth on your traditional IRA will be subject to ordinary income taxes. Now, the basis, aka what you put in and you didn't take a deduction on, that won't be taxable, that'll be tax-free. But really, that's just a return of your own contribution, so there's not really huge value there. In addition, that non-deductible traditional IRA will still be subject to required minimum distributions when you're in your 70s, which for most of my clients who have done a great job savings, required minimum distributions are a hindrance to their tax efficiency because generally we've saved a good amount in various buckets that they don't need to take out the amount of money that the IRS says they need to, which really just pushes them into a higher effective tax bracket, and they end up paying more in taxes on their traditional IRA withdrawals than they really needed to because they didn't need the money. And last thing, from an administrative standpoint, you'll need to start filing Form 8606, assuming you want to track what portion of your traditional IRA is non-deductible, which you do. It adds some administrative hurdles. It's not the greatest financial planning tool in the world, but technically it's still an option. The biggest reason why I have clients fund non-deductible traditional IRAs is so that they can set up backdoor Roth IRAs on an annual basis. For more information on how a backdoor Roth IRA works, I'll link to a video I did a few years ago on that. And that might be helpful in understanding some of the nuance that goes into non-deductible IRA funding. But ultimately, the strategy is to get money into a Roth IRA when otherwise your modified adjusted gross income levels are too high. And the third reason why I see clients fund non-deductible traditional IRAs is when they funded a Roth IRA throughout the tax year. And then when they're doing their taxes the following year, they realize after doing a modified adjusted gross income calculation that their modified adjusted gross income was too high to allow them to fund a Roth IRA, and they need to recharacterize their Roth IRA contributions to traditional IRA contributions, but non-deductible ones. I should clarify, not only do they have to recharacterize their Roth IRA contributions, but they also have to recharacterize what's called net income attributable. They have to get that out of that Roth IRA. We'll do a video another time on how to do that calculation, but lo and behold, it's not as simple as just take out your contributions, because there was growth presumably within that year of you funding that Roth IRA that you shouldn't have been, and you have to take out that growth as well. Generally though, I really don't see that the juice is worth the squeeze on funding a non-deductible traditional IRA on an ongoing basis without doing anything else. I just don't see the tax benefits as far and exceeding what somebody else would like in liquidity by funding, say, like a non-retirement investment account. That said, it absolutely could be in your best interest. Speak with your tax professional and your financial planner for a better synopsis. I get questions all the time on whether Roth conversions or rollovers are considered funding of a traditional IRA or Roth IRA. And to put those at ease, no, the answer is absolutely not. No, you can still fund Roth IRAs and traditional IRAs regardless of how many rollovers or transfers or Roth conversions you did for that tax year. So calls to action is ultimately to identify what is your IRA funding strategy. You might not take any action today, but it's good to know what you have the ability to do. A lot can change in 12 months. You might get a big bonus and you might want to save that. And it pays to know what your options are for saving in the most tax efficient way. So hopefully that was helpful in breaking down the rules relative to funding IRAs and some of the nuance. If you have further questions, drop them in the chat below, send me an email, we'll get you squared away. Have an awesome rest of the week. We'll chat with you later. Bye.